It's becoming harder and harder as of late to find undervalued stocks in the market or stocks sitting pretty close to their 52-week close. They are not crazy value traps in general. And in this video, I have two undervalued stocks sitting pretty close to their 52-week close. I think they're undervalued, and they also pay a pretty decent dividend for dividend investors that are on my channel, but the dividends are a little bit small, so they have a lot of price appreciation and they have like a 3 to 4% dividend. So I think these stocks will be very interesting. One of them I've never discussed before. I'm analyzing it recently and I'm going to share it with you guys on the channel. And the second one is a stock that I'm pretty much known for talking about in terms of dividend stocks, and I think it's one of the most undervalued dividend stocks in the stock market. I'm going to discuss it later in the video, and I'm going to start with the first one. And these kind of videos, they don't get a lot of views, so all I ask, if you could please press the like button if you enjoyed this video, and maybe consider subscribing if you're new to the channel. Now, the first stock that I've never talked about before, and it's a pretty interesting company I used to own in 2018, and then I sold it, never went back to it. This is a company called GPC, Genuine Parts Company. You might have heard me talk about Advanced Auto Parts, AutoZone, O'Reilly's, and these kind of auto parts store, where you also have GPC, Genuine Parts Company, operating in the United States, in Europe, and in Australia. The stock has been beaten down a lot, sitting at $137 per share, pretty much the same price it was sitting at in 2021, pretty close to the 52-week close. It's pretty hard to find them these days after the S&P's massive recovery back to 4,500 and pretty much 50. It's been a pretty stellar recovery. So as I talked about, Genuine Parts Company has these auto parts stores and distribution centers in the United States, 15% in Europe, 9% in Australia. They also sell some industrial equipment. 38% is industrial, 62% is automotive. If you live in the United States, you might have seen stores like Napa Auto Parts. Napa Auto Parts is the brand of GPC in the United States. They have different brands in Europe and in Australia, and they have been very successful, and the stock is not like Advanced Auto Parts. Like, it's not a garbage company. The stock has gone up over time. They have good management. They have the right model, pretty good return on invested capital. So it's not like a trash stock at all or anything crazy. It's just been struggling lately, and it's in a good long-term upward momentum in general, but it has struggled a little bit. And this is where we could potentially find an opportunity to invest in this company again after I sold it in 2018, and I shouldn't have sold it. Now, one of the reasons why it has been beaten down so much is they have declining sales in the United States. It's pretty bad. I mean, 1.1% decline, 2.9% decline in comp sales. Now, if you look at Canada, Canada is up 3.7%. Europe is up 10.9%, double digits for this company. Pretty amazing in Europe. Australia is up 6.2%. So everywhere else, it's doing amazingly well, but it's declining in the United States. It's losing market share to companies like AutoZone, like O'Reilly's. Advanced Auto Parts is losing to everyone. So it's mainly AutoZone and O'Reilly's. They're taking market share from GPC and also from, something like Advanced Auto Parts. But I personally believe the decline was a little bit overblown because the company is still putting up good metrics, still posting good profits. It's still raising guidance. If you look at their guidance, it's still 4 to 6% in terms of sales growth. EPS per share, it's still around 10.3 to 11.5. They raised it a little bit. So they're still growing double-digit EPS for this company, and everything is still going on track. They're growing double digits in Europe, and everything is going fine. But it's declining a little bit in the United States. The market freaked out because it's a pretty large region for them, but it's offsetting them from outside the United States. But again, the market, I think, overreacted. Massive overreaction. It happens. I don't believe this massive sell-off is warranted in GPC stock, and I'm going to show you some valuation metrics a little bit. But the company has good management. I mean, really good management, and they have been very, very disciplined. They spend 31% of the free cash flow in terms of CapEx and stuff, not free cash flow, cash from operations. They spend 19% on mergers and acquisitions. They spent like $211 million this year acquiring other companies and smaller players. It's pretty amazing stuff. 50% buying back stock, shares outstanding have been coming down, and 35% on the dividend, and they do raise the dividend over time. Now, in terms of where GPC is trading at right now, it's trading around pretty close to 13.9 times earnings, around 14 times earnings. Now, the 10-year average has been something around 18 times earnings. Now it's sitting at 14 times, which is pretty interesting to me just because it's declining a little bit in the United States. I mean, yes, that's concerning, of course, But still, outside the United States, the company is doing very, very well, and they're growing into fast markets from the acquisitions they have. They have a good management team. If you compare it to AutoZone, it used to trade in line with AutoZone. Now AutoZone is trading pretty close to 18 times earnings, while this company is trading around 14 times earnings, which would tell me in general that if the sales in the United States reverse and they stop declining, GPC will most likely return back to its mean multiple of something around 18 times and trade where AutoZone is trading at around 18 or to 17 times. So that would give me a multiple expansion in terms of the return with something like GPC. I'm also getting EPS growth. EPS has grown around 11% in 2023. From 2024 to 2026, it's expected to be between 7 to 10%, so around 8 or 9% on average, as you could say. So I'm getting a potential multiple expansion. I'm getting worst case scenario like a 7% EPS growth, best case scenario around 10%, like it's been growing in 2023 and it grew before. So pretty much close to double-digit EPS growth. I'm getting a multiple expansion, and I'm getting a dividend for dividend investors. They have been raising dividends very, very well, around 6% on average. They recently, raised it around 10% to make up for the lower 2 years of around 3.6%, but the dividend yield is around 3%. So you get a 3% dividend yield that's going up around 6 to 7%. It's pretty safe, pretty well covered in a bulletproof kind of industry. Recessions, inflation, no matter what happened, it's going to be a good at least 15 years, in my opinion, before EVs have any toll on these, part kind of companies. People say it's sooner. I don't believe it's sooner. I think most economies are still going with gas cars for now, and even EVs, they're gonna need some parts. GPC might be able to supply these parts, and they have their industrial kind of business within the Napa Auto Parts. So it's a pretty resilient business model, trading around 14 times earnings with a 3% dividend, growing EPS 7 to 10%. I think GPC is undervalued. Maybe it's not the best bargain in the world, but relative to other opportunities in the market, especially for something like a safe dividend stock with bad sentiment, I think GPC is pretty fairly valued to more on the undervalued side, in my opinion. I mean, I could see something between 10 to 12 or 13% annual with something like GPC. It depends where their EPS, but a 7% EPS growth, which is the worst case scenario, in my opinion, and something like a 3% dividend, and then you still have the multiple expansion. That's pretty nice. And EPS could end up being 10%, like it's been lately. So I think GPC is an underrated company. Most people don't talk about this stock. It's undervalued. I'm considering it for my own portfolio. I'm still researching the company. I share the things that I do in my own investment group. If you're interested in joining and discuss certain stocks and talk about all these stocks I talk on the channel, I talk all about them in the Discord. If you interested, you could check out the link in the description. Now, the second stock, which I believe is the most undervalued dividend stock in the market, I talked about it many times. I'm sorry, please forgive me, guys, for sometimes talking about the same stocks all the time. But I just hate having to go to look for a new stock just because I need to change or I need to, be modern or whatever it is, and just go find different stocks and own 50 stocks if I know one that's undervalued and I have high conviction in. And this stock is Mid-America Apartment Communities. I talked about it many times. Maybe you're sick of the company, but I talked about this one, and I talked about Realty Income. Realty Income has been playing out. People also trolled me on this one. They say it's going to 32, trash company, you're pumping junk and all these things. Well, now it's playing out. And maybe this is a fake and it goes lower, but I mean, 6% dividend with 3 to 4% AFFO and a multiple expansion wasn't bad at all. And I see something even better with Mid-America. Mid-America, in my opinion, is the most undervalued dividend stock or REIT in the market. Still sitting at $125, pretty much close to pre-COVID levels. Now imagine how much their apartments are worth, much more than pre-COVID, how much rent is higher than it was pre-COVID, and the stock is still trading well below pre-COVID levels with a pretty amazing balance sheet. I'm going to talk about it a little bit more. And Mid-America, most of you know, they own these apartment complexes and apartment buildings, mainly on the Sunbelt area. A lot of it is in Florida and Georgia and Texas, in Tampa, Orlando, these kind of markets, Charleston, South Carolina, pretty much all the markets you want to be in over the long term. This is where these markets are experiencing a net migration. People are moving from California, from New York, from Washington, all these, Chicago and all these places. They're coming to the, Sunbelt area for a warmer weather, better jobs, better market, lower taxes. And these kind of apartment complexes have been benefiting from increasing rents, from having very high occupancy rate. And this is pretty much where you want to be invested in over the long term. Now, this company does not need any introduction for dividend investors. A lot of you are familiar with it. It has a good track record of increasing core FFO per share, of increasing the dividends. They have been pretty much increasing it every single year from 1995. They've never suspended the dividend ever. They've been pretty much growing it all the time. These apartment REITs are amazing dividend payers. I own them many times before, and I keep kind of trading them. Now, one of the reasons why the market has been pessimistic around Mid-America is because of the new leases. The new leases in terms of price growth, it has been declining. It declined around 0.5% in Q1, or if you want to look at it year to date, it declined 1.2%. Now, the renewals, they increased prices 6.2%, but the blended effect is around 2.6%. And this is what the market is really freaking out about, is because before that, Mid-America used to increase rents around 5-7%. But then after COVID and after people started moving more to the Sunbelt area, they were able to increase them 10 to 12%. And the market looked, 10 to 12%, that's very high, amazing, and it rewarded Mid-America. And Mid-America apartment communities pretty much shot up to $230. The stock was yielding less than a 1% dividend, And it's just, the market loved the stock whenever it was seeing these rent growth at something like 10%, 12%. But this is not sustainable. Things have to normalize and go back over the long-term average. And the long-term average for the areas where Mid-America is in is around 5%, 5 to 6%. Well, now it's around 2.6%. But after growing double digits for 2 years, what do you expect? Of course, we're going to have a flat year or a flat 2 years or maybe a decline, a normalization period. And after that, things are going to go back to normal. And Mid-America is going to raise rents 5 to 7% every single year. But the market's freaking out. New leases, the renewals are still 6.2%. Yes, the new leases declined 1.2%, but things are going back to normal. And I think this is very, very normal. Occupancy is still very, very high. And the market is just freaking out about it. And this is the kind of situations I love, because this is another overreaction scenario with something like Mid-America. They have a good balance sheet, no crazy debt maturing in the near term. It's all 100% total debt is fixed at around the 3.4% interest rates. This is pretty amazing with something like Mid-America. But the reason why I love these kind of REITs is because they normally can raise rents 5 to 7% on renewals. And this is not even including if they, redevelop some new properties and increase rents, or if they acquire other properties or just build more apartments in general. This is even more, because they can grow like 5 to 7% in FFO per share growth just from raising rents without even having to go dilute stock to do all these things. Mid-America's shares outstanding are flat. They don't even need to dilute stock. These kind of companies are amazing companies, and they are trading for multiples. They are pretty close to the retail REITs like Realty Income, and these companies should be trading at a premium. Something like Mid-America, if you look at the price to AFFO per share, it's now sitting at 15 times AFFO. The mean was 20 times. Now it's sitting at COVID levels, whenever pretty much in March 2020 levels. It traded as high as 33 times. Now it's trading around 15 times. The lowest it has ever traded at over the last 10 years is around 14 times, and now we're sitting at 15. So this kind of tells you the sentiment around this REIT. I'm not sure for how long this is going to continue, but this is one of the best opportunities I've seen in a while. I don't know what I'm missing. If I'm missing something here, you could let me know in the comments. Maybe I'm missing something. Please let me know. But I'm just not really seeing what could pretty much go wrong with a company with a good balance sheet and something like Mid-America. Maybe it takes longer to raise rents like they used to, but it's eventually going to normalize. It's eventually going to happen. So dividend is around 4.3%. It's shot up a lot. I remember when it was trading like a 1.7 or 1.8%. It was like in 2018. It was crazy, like 1.8%. Now it's trading at 4.3%. And no one really wants it anymore with pretty good FFO per share growth. They used to grow FFO pre-COVID around 9 to 10% every single year. And this is why these companies have lower dividend yields, 1 to 2%, because they grow higher FFO. They normally have lower dividend yields. So you could pretty much never get a 4% dividend yield on something that could grow 10% in FFO. But now you can actually do that if you're a little bit patient. 2024 is expected to be bad, around 1.6%. And it's expected to reaccelerate and grow between 7 to 10% after 2024, after this rough period is pretty much over. So 7 to 10% in something like AFFO, even 5% if the analysts are wrong, 5% is still cheap with a 4% dividend and a potential multiple expansion. I'm not saying interest rates are gonna go to zero. This is what a lot of you tell me. They say, yeah, but you value these REITs and you tell us the mean multiple is 20 times, now sitting at 15, but we had 0% interest rates anymore. No, when we had 0% interest rates, Mid-America did not trade at 20 times. Mid-America traded at something like 33 times at the peak. The peak was 33 times. I'm not betting on Mid-America to go back to 33 times. I'm betting on Mid-America to go from 15 times closer to 18 to 20 times what it was trading at in 2018, whenever we had the 2% interest rate, or was it 2.25% or something, 2.5%, I forgot what it was, but in the 2% rate. This is what I'm betting on. I'm not betting on 0% interest rates. I'm betting on a neutral rate of 2.5% to 3%, like Jerome Powell said. So I would expect Mid-America not to go from 15 to 33 times, but to go from 15 to 20 times, which would still be a massive return potential for the company. So I still believe it's very undervalued. And this was my opinion on these two REITs. Or not REITs, actually dividend stocks. It was not financial advice. I hope you enjoyed this video. So if you did, please press the like button and maybe consider subscribing. So I hope to see you in another one.